Okay, let's unpack this one. It's a really unusual earnings report we're looking at today.
It really is.
We are diving into the Q2 fiscal year 2026 results for Scholastic. They came out after the market closed on December 18th.
And, the numbers told one story, a story of incredible operational success.
But the stock reaction told a completely different one filled with, I guess, investor anxiety.
That divergence is really the heart of this deep dive. Management delivered this extraordinary profit beat.
A huge beat.
Right. But the market just reacted with total skepticism. The stock sold off 6.15% the very next day.
And the volume was huge.
Quadruple the average trading volume. So big money was moving.
So our mission today is to figure out why. Why did investors look right past a record quarter and this huge financial move they made?
It's a classic case of the market focusing on the quality of the revenue versus, the quantity of the profit.
Let's start with the headline numbers then, because the profitability, you have to say, was genuinely exceptional.
It was. Non-GAAP diluted EPS came in at $2.57.
And consensus was what, like $2.07?
Exactly. A full 50-cent beat. Just phenomenal.
And the underlying operations looked really strong, too. I'm looking at adjusted EBITDA.
Yeah, that's the key metric for cash generation. It grew 13% year over year to $122.5 million. It shows a very healthy core engine.
It does. But, and there's always a but, the issue showed up right at the top line.
Right at the top. Revenue came in at $551.1 million.
Which was only, 1% growth?
Just 1% year-over-year growth. And maybe more importantly, it missed what Wall Street was expecting, which is around $556.7 million.
It's a small miss, but I guess it was enough.
It was the hook investors needed to hang their skepticism on. And that verdict is swift.
A 6.15% drop. The volume spike just tells you that institutions were selling. They were focused squarely on the risks, not the profits.
So let's talk about the core strength first. The part of the business that is just firing on all cylinders.
And the children's book group.
Exactly. Their vertical integration is just so powerful. Segment revenue was up 4% to $380.9 million.
And inside that, the real engine room has to be the book fairs.
Always is. It's their cornerstone. They pulled in $242.0 million.
That's a strong number.
A very strong 5% jump year over year. And management sounded really confident, projecting more fairs this year, 92,000 up from 90,000.
And it's not just more fairs, right? It's the quality of the sales at those fairs.
That's the key. It's being driven by increased revenue per fair, or RPF. And they shared this fascinating little piece of data.
Oh, yeah.
While the number of kids actually buying might be down a little, the revenue they get per buying kid is way up.
That suggests they're getting merchandising right. The book selection, the pricing. They're just maximizing every single interaction.
Absolutely. And you have to just marvel at the cultural power of their IP. I mean, Dog Man. Teachers in some schools apparently struggle to get kids to read anything else.
That's an incredible moat.
And that IP content side, the trade publishing, is so lucrative. Revenue was up 7% to $110.4 million. Just undeniable strength.
So tell us about the specifics. What were the big hits driving that number?
Of course. The 14th Dog Man title, Big Jim Believes, it debuted as the #1 best-selling title.
Not just for kids, right?
Across all categories. With over 2 million copies already sold in print. That is just pure cash flow.
But I guess the challenge there is, how do you keep cycling against these massive hits year after year?
That's the eternal question for any content business. But they are also just expertly managing their backlist.
The older IP.
Right. The Hunger Games is still selling like crazy, almost 5 million copies since the new title in March. And Harry Potter is getting a boost.
The HBO series is coming.
Exactly. Huge anticipation for that in spring 2027. And they're doing a new interactive illustrated edition. It keeps the franchise fresh.
And I saw they're being smart about new formats, too. They're taking Captain Underpants into manga.
Yeah, the first epic manga. They're chasing where the market is growing, not sticking to the old hardcover playbook.
Smart. So beyond the physical books, what about digital?
Continued momentum there. This is where the long-term value is really going to come from. They said production is starting on 3 premium animated series.
That's how you turn print success into recurring licensing revenue.
It is. And their own digital platform, Scholastic TV, is getting real traction.
I saw those numbers. Over 350,000 downloads.
And 64 million minutes watched since September. It shows that brand loyalty translates directly to screens.
And the big partnership they announced.
With Mark Rober. The Crunch Labs YouTube channel. This is really strategic.
I mean, his audience is massive.
Over 70 million subscribers, mostly kids.
Yeah.
This is about building a modern digital funnel right back into the core publishing business.
Okay, so we've covered the good news, the drivers of that big profit beat. Now we have to pivot to what caused that market sell-off.
The revenue drag.
Yeah, and that weakness is all coming from one place, isn't it?
It falls squarely on the Education Solutions segment. This is the business selling curriculum and software directly to school districts.
And the performance was not great.
It was challenging. Revenue fell pretty significantly, down 13% year over year to $62.2 million.
And this segment is just inherently volatile. It's all tied to government money.
That's what management cited. Volatile, federal and state funding, delays, districts just making decisions more slowly.
So it's not just a Scholastic problem.
No, they said it's across the whole industry, but it's definitely hurting them right now.
But what's crucial is how they reacted to it on the cost side.
Exactly. They went through some intense restructuring and cost mitigation. So even with that 13% sales drop, the segment's operating loss was almost flat.
So they're right-sizing the business for this tough environment.
They are. But the market is asking, how long can you just cut costs? At some point, you need sales.
Right. Cost discipline isn't a long-term growth driver.
No, it's not. Management is betting on things stabilizing in the second half. They think that declines will moderate as their sales execution improves, and hopefully that federal money finally starts to flow in Q4.
But for now, this segment is the big risk factor for the stock.
It absolutely is. And we should also mention the book club segment.
Another small drag.
A 14% revenue decline there to $28.5 million. It just adds to the narrative that the school-based channels are under a bit of pressure.
Okay, so let's get to the big structural change, the thing that completely transformed their balance sheet.
The strategic pivot. They executed 2 huge sale-leaseback transactions.
One for the NYC headquarters and one for a distribution center.
Correct. The Jefferson City Distribution Center.
Can you just quickly break down what a sale-leaseback means for anyone who isn't familiar?
Sure. It's basically trading asset ownership for cash. They sold the buildings to an investor.
And that generated a massive, immediate cash windfall.
About $401 million in net proceeds, instantly. And in return, they just signed a long-term lease, so they stay in the buildings, but now they're renters, not owners.
So their cash position was transformed overnight. What was the plan for all that money?
First thing they did, the board expanded the share repurchase authorization to $150 million.
So giving it back to shareholders.
Management was very clear. Returning cash efficiently to shareholders is the top priority right now.
And this was all reflected in their updated guidance, which saw a pretty major change.
A massive change. They updated their full-year free cash flow forecast to over $430 million.
And that's up from what, like $30 or $40 million?
Exactly. It's almost entirely from the real estate sale. A huge shift in their financial posture.
And here's the other side of that coin. This cash comes with a trade-off.
This is the crux of the investor anxiety. They reaffirmed their adjusted EBITDA guidance, but they specifically said it now includes a rent impact.
And how much was that?
About $14 million in new rent obligations for just part of the year.
And that $14 million is a permanent structural headwind going forward. It's not a one-time thing.
That's it, exactly. It highlights the difference between a one-time cash benefit and a permanent recurring operating cost.
And the market weighed that new cost, plus the weakness in Education Solutions, more heavily than the cash infusion and the EPS beat.
It explains the divergence perfectly.
Management, of course, spent a lot of the call talking about the transformation they've completed over the last 4 years. New leadership, streamlining the business.
And returning a lot of capital.
Yeah.
Nearly $500 million to shareholders since fiscal 22, which cut the share count by 25%.
But the stock's future now really hinges less on that history and more on 2 things going forward.
1, stability or recovery in that volatile education segment.
And 2,
aggressive, smart execution of that new buyback plan to drive per share value.
it's a fascinating test of strategy versus execution.
This is where we transition to our This Is Not Financial Advice segment.
That's right. Everything we discuss here is for informational purposes only. Please do your own research, consult with professionals. This is not a recommendation.
Okay, so here's the setup. The company has basically de-risked its balance sheet with this $401 million windfall.
Right. And their core IP business, fairs, and trade is incredibly resilient, profitable, predictable.
The education segment is the big risk factor, but they're actively working to right-size it.
So what's the outrageous but plausible trade?
Go on Scholastic shares. You're anticipating an accelerated, very effective deployment of that initial $150 million buyback,
And maybe more to come.
potentially followed quickly by a special dividend or just expanding the buyback with the rest of that cash.
So the thesis is that the market is just overlooking the value that's going to be created on a per-share basis as they buy back stock at these low prices.
Exactly. They are effectively paying you to wait for that education solutions market to finally recover.
Which could happen if that federal funding finally gets unstuck.
Right. The value of the core IP provides a really strong valuation floor. So if you just decide to ignore the education segment for now,
Treat it as a zero.
treat it as a zero. The capital return plan makes that entire segment a free call option on a future government funding recovery.
It's a fascinating structural value play. You're betting on the financial engineering to offset the operational volatility.
That's the trade. It's a test of whether a high-quality, cash-generating core business can power through a sector headwind when management has this much capital to deploy.
So, to recap the quarter, the core publishing business is healthy, profitable, and driven by really powerful IP.
The education segment remains challenged, but they're managing the costs. And most importantly, they executed this huge capital shift, giving them immediate liquidity for a big buyback.
Okay, so our final provocative thought for you to consider is about their long-term digital strategy. Can the scaling of platforms like Scholastic TV, plus these major brand partnerships like the one with Mark Rober, can that transform their IP into a meaningful, recurring revenue stream?
One that's generated outside the classic.
Exactly. A revenue stream that could finally overcome the structural volatility caused by those government spending cycles in the education segment.
That is the ultimate challenge for them, isn't it? Shifting their revenue mix away from depending on unpredictable federal budgets, if they can pull that off.
Then the education segment just becomes a nice bonus rather than the thing that defines the whole story.
Precisely.
Thank you for joining us for this deep dive.